The taxation system in the United States is complex and multifaceted, impacting individuals from all walks of life. However, W-2 wage workers, those who receive a traditional paycheck, often find themselves paying a substantial portion of their income in taxes. In contrast, alternative income sources, such as real estate and long-term securities investments, can provide avenues for reducing taxable income. Additionally, capital gains taxes offer distinct advantages over income taxes. This video explores the reasons why W-2 wage workers tend to pay a significant amount in taxes, examines alternative income strategies involving real estate with cash-out refinances and investments, and discusses the differences between capital gains taxes and income taxes. Income taxation, the burden on W-2 workers. W-2 wage workers, often classified as employees, have their earnings subject to various federal and state income taxes. These taxes can take a significant bite out of their paychecks. The progressive nature of the income tax system means that those with higher earnings pay a larger percentage of their income in taxes. The tax rates for the 2023 tax year for a single individual are as follows: 10% between $0 and $11,000, 12% between $11,001 and $44,725, 22% between $44,726 and $95,375, 24% between $95,376 and $182,100, 32% between $182,101 and $231,250, 35% between $231,251 and $578,125, and finally 37% for $578,126 and above. This can result in a substantial financial burden for individuals in higher income brackets. W-2 wage work is not the ideal method for creating wealth for the following reasons: payroll taxes. In addition to income taxation at the federal and often state level, W-2 wage workers are also subject to payroll taxes, which include Social Security and Medicare contributions. While these taxes fund essential social programs, they can reduce disposable income significantly. The Social Security tax, which is 6.2%, is levied on the first $160,200 for the 2023 tax year of earned income, while the Medicare tax, which is 1.45% up to $200,000 and then 0.9% for any income above, applies to all earned income with no cap. Limited deductions. W-2 wage workers have limited opportunities to reduce their taxable income through deductions. While they can claim standard deductions and certain itemized deductions, their ability to lower their tax liability is constrained compared to self-employed individuals or business owners who can deduct various expenses related to their work. Lack of tax credits. Tax credits, which directly reduce tax liability, are often more accessible to low and moderate income individuals rather than high earners. W-2 wage workers in higher income brackets may find it challenging to benefit from these credits, further increasing their tax burden. Alternative income sources include real estate and investments in securities, such as stocks and bonds. Real estate investments offer a tax-efficient income source for those seeking to reduce their taxable income. Rental income generated from investment properties is generally taxable, but it can be offset by various deductions and credits. These include deductions for mortgage interest, property taxes, depreciation, and expenses related to property management. Along with the standard income one receives from real estate and rental property, real estate investors can take advantage of cash-out refinances. Cash-out refinancing allows homeowners to tap into the equity of their property by refinancing their mortgage for an amount greater than the outstanding balance. The funds received from a cash-out refinance are considered a loan and are not taxable income. Borrowers can use this money for various purposes, such as debt consolidation or investments. And when the funds are coming from a rental property, it is the tenants of the property who essentially pay the funds back. Lastly, there are 1031 exchanges. Real estate investors can further reduce their tax liability through 1031 exchanges, which enable the tax-deferred exchange of one investment property for another. By avoiding immediate capital gains taxes, investors can reinvest in more profitable properties, effectively deferring their tax obligations until a future sale. Investment in long-term securities, held for at least 1 year, are not subject to standard income tax rates but rather capital gains tax rates, which are much more favorable to earners than income tax rates. Capital gains tax is levied on the profit from the sale of capital assets, such as stocks, real estate, or businesses. The tax rate for long-term capital gains, which are assets held for over 1 year, is typically lower than income tax rates. For most taxpayers, the long-term capital gains for a single individual are as follows: 0% between $0 and $44,625, 15% between $44,626 and $492,300, and 20% for all income above $492,300. Benefits of capital gains taxation. Capital gains taxation encourages investment and long-term wealth creation. The lower tax rates provide an incentive for individuals to invest in assets that can appreciate over time, fostering economic growth and entrepreneurship. Moreover, the ability to defer capital gains taxes through strategies like 1031 exchanges can further enhance investment opportunities. W-2 wage workers often find themselves burdened by significant tax liabilities, largely due to the progressive income tax system and payroll taxes. However, alternative income sources, such as real estate and long-term securities, offer opportunities to reduce taxable income and build wealth. Capital gains taxation, with its lower rates and incentives for long-term investment, provides a tax-efficient avenue for generating income and wealth. Understanding these tax dynamics is crucial for individuals seeking to optimize their financial strategies and minimize their tax burden in the complex world of taxation. By exploring alternative income sources and capitalizing on favorable tax treatment, individuals can achieve financial security and potentially reduce their reliance on traditional W-2 employment income.